I want to educate America. I want to unbrainwash America about money.
I mean, there are lots of ways to create wealth, but what I'm talking about is what is the most assured, reliable way. If you don't build it in your lifetime, your kids certainly can, right? Every single person has built wealth in this manner.
What is the biggest mistake you see women making with regards to investing?
Too conservative. The best way to create wealth is to have...
Thanks for being on the show today. I was very, very impressed with you on a space where we were talking on DeFi, and I'm like, I got to get her on the show. So welcome to 10X Money Talks, everything money, finance, investing. Alexandra Damsker, corporate and securities lawyer. So I've never had a securities lawyer on the show, but you might be able to help me with some things that I'm trying to do right now. Former SEC attorney, two-time founder, best-selling author of Understanding DeFi, which I want to go into because I want to understand what this whole DeFi thing is. Thank you for being here. Great to have you as a guest.
Thank you so much for having me. It's a pleasure.
So let me ask you, how does somebody become a corporate and securities lawyer?
Law school?
I mean, why does somebody want to do that?
That is a very good question. So the way it happened for me, I actually went to law school thinking that I was going to be, I don't know if you know who this is, but Carla Ponte, who prosecutes international crimes at The Hague.
Nice.
So that was my plan. My plan was actually, I chose my school. I worked at the U.S. Institute of Peace. I actually was what's called a Jennings Randolph Scholar. I did all sorts of stuff that was very focused on international law and borders and stuff like that. So when people ask me, like, how do you know about international law and trade and stuff like that, it's because that was my focus for a long time. Then I realized how hard it is to get into those jobs. It's really tough. Like, most people are actually the children of diplomats that get into those. So it's very, very, very tough to do that. I was actually a presidential management internship finalist, which is like a prestigious thing. It's, bless you, it's all this stuff that nobody cares about outside of Washington. But anyway, I did all this stuff, and then I got offered this job at the SEC, and out of law school. And
you're how old at this point?
Do I have to say?
Yeah. Well, no. When you got your
When I got the job, so I went to college very early.
Okay.
Went to college when I was 16. So. I was very young. I was like celebrating basically like a quarter century of life when I was at the SEC. So I was super, super young, and everyone told me how prestigious this was to work at the SEC. It is, right? It's legit, super, super prestigious. So I had all these, I had offers of all these different jobs while I was going through the presidential management thing. And it was like one of the, biggest things to get. And they're like, oh, you should take this thing. Having never had any sort of guidance in what to do, I took that job. And voila, I am a corporate and securities attorney. So I wish I had a better story for you of like, when I was a kid, I used to walk around with a briefcase, and I was like, I'm going to be an M&A attorney, and I'm I'm going to be this securities guru or whatever. But the way it just happened, it was sort of like, I'm really, I was just really good at it. And it just turned out to be a really good fit, that I'm really good at securities and corporate stuff. But it was just the most prestigious thing. And I had everybody basically telling me, this is the job you want out of school. It's the best job you're going to get. It turned out to be a really great job. I mean, you hit the ground running. There's nobody, basically, there are no layers there. So you're doing everything from the first day. And so I ended up learning so much more than I would have at one of the top firms. So I had like this idea of what all the rules were, what they meant, how to get, like how the law actually works, how the regulatory agencies work, how they all work together and things like that. So it was great training, but it was just sort of like, okay.
Yeah, that's wild. So this is great. I didn't plan on asking you this, but what is the purpose of the SEC? I didn't plan on going down this rabbit hole, but now I'm very interested. What is the purpose?
Okay, so the SEC is
Who created it? Who created it? And how has it been preventative?
okay. This is This is absolutely. I'm a big history buff in general. And if you ever hear me speak, you'll always hear me go down these like, here's how how we are where we are today, because of the string of decisions that were made in the past that leads us to where we are today. So the SEC came out of the Great Depression.
Mm.
And it was really because of a series of events that happened where essentially in the easy credit days of the 20s, people were able to buy a lot, were able to get into the stock market. And it wasn't really being able to get into the stock market that was the issue. It was being able to get into the stock market on margin. That was the issue. But that's not the problem that they solved, right? The problem that they solved was access. It wasn't leverage, right? Leverage is borrowing money and making bets. The access issue is the ability to invest in companies, right? So investing in companies with money you have is one thing. Investing in companies with money you don't have is the problem, really. So the easy credit of the 20s that had a bunch of people who didn't know anything about finance, really, and investing their money in companies and borrowing money to invest in companies that they didn't know anything about, that was really the problem. And it resulted in a bunch of people losing a ton of money. And the biggest issue that happened was that then they became, there was all these people who were unemployed, and then they became problems of the state, right? And I mean the state, the capital S state, like the state, not just the states, right? But the federal government. So they instituted all of these rules that essentially prevented a bunch of people from investing in things that they don't know, and disclosure requirements. So there's two basic types of requirements. One is the majority of companies, which is the disclosure rules. This is, tell us everything you're doing. We're not going to tell you what to do. You have this this business judgment rule that governs everything, which is, look, as long as a reasonable person with business judgment would agree that what you're doing is sound business decision, it's fine as long as you tell people that's what you're doing, right? That's the disclosure regime, and that's most operating companies. There are a few companies, though, that fall under a different regime, like banks and funds and things like that. And those are the very restrictive, basically ask first regime, right? And that is, you got to ask us first, we got to approve it, and then you can do it. And no innovation in the entire world has ever come out of these companies, right? This is banks and everything like that. And they have to ask first, they have to get approval. And they're always trying to get loopholes of, no, this regulation shouldn't apply to us. No, this regulation shouldn't apply to us. We basically want to have all of the good things of all the banks and things like that. We want to have access to that money so that we can make more money. But we don't want to be able to not innovate. We don't want to be able to have to ask you first, right? Because the approval process is so long. It's
Right.
long. It's made by people who don't understand necessarily all of the complexities. They don't understand how short the window of business decisions really is. That's a big problem, right? The window of business opportunity is incredibly short. And most lawyers and accountants and things like that, they don't really understand how small their role is in business decisions. I didn't until I ran a business, right? I
Right.
thought I was like, this is what lawyers say, I'll put my business hat on. When I was, I had worked with so many startups and so many banks and so many investors and so many like VCs. And then I ran a company and I was like, this is going to be so great. I started a company. My first year, I was basically in the fetal position. I was like, I don't know anything.
Right. Right.
So they don't realize how small their knowledge really is relative to the breadth of a business decision. And that's really the biggest problem, is that you miss opportunities by having to go through the approval process. So who are they protecting is supposed to be investors.
Yeah. So the SEC was created in 1920, in the 20s, after the big crash.
The 30s. In the
30s, I'm sorry. And after the, I guess, the 29 crash.
Mhm.
And the intention was to protect investors or to stop the over leveraging. And then it morphed into something else that basically makes it very expensive and almost hostile to an entrepreneur to go do something on Wall Street today.
Yeah, because they didn't really actually intend for it to be expensive or hostile. What they intended for it to be was, let's give you the information that you need, or let's make sure what you're doing is safe. None of that is really business friendly.
Right.
The biggest issue, in my opinion, is the accredited investor rule, right? That is the biggest issue because the
Which was created when? I'm sorry, Alex.
That's in the 30s.
Okay.
That's an old rule. And that was essentially saying that you had to have enough capital, right? You had to be basically rich in order to access private investment. Now, private investment in private companies, has been the number one most assured way to gain wealth in this country. It's not actually building an operating company or other ways that, lotteries or things like that. The most assured way to build wealth, that step has to be, you have to become an accredited investor and start investing.
You're saying the most assured way is to invest in a private company
in a series of them
before it's public.
Before it's public. All of the
Where's that data, Alex, come from? Where's the data that's the most assured way?
Oh my God, there's tons of information on it. I can get it to you, but there's tons of data on it. I mean, it's because the massive accrual of value is while it's private, right? While it's being de-risked. But that is what investors do, is invest in private companies. Now, not one private company, but a series, right? You invest in an array of things, right? You diversify your investments, but you have to invest in them when they're higher risk.
Yeah.
And then when they're low cost, and then as the team proves itself and de-risks, when you exit, right, assuming you get 1 in 13 go to some exit event, right? You get to some exit event, then what happens is you're trading your de-risked shares at a low value,
right?
Your risky shares at a low value to de-risked shares at a very high value, either to another company that's purchasing them or to the public.
Good. And now, hang on 1 second, just so we could, for the audience. Okay. Now, this right now is excluded from almost 98% of the population that is not accredited.
Right.
And that number to accreditation just recently got changed. So I have always been an advocate that this accreditation borders on discrimination. What is
sure? I agree.
Uh-huh.
Go ahead. I'm sorry.
Because to me, the guy that has 100,000 is the one that actually needs that private investment more than a guy that has 100 million.
I absolutely agree.
Why was the rule? What was the real intention, or did it get twisted?
So I think now my view of the world, as much as I'm a total cynic, but it's because I really believe in the good of people. And then they continually disappoint me.
Yeah.
but I truly believe that when this was created, they thought, look, if you have money, at least if you're investing it and it goes bad, right? Then then you've got something to fall back on. But really, here was the underlying meaning. The state at the time couldn't afford more people on welfare. So what they really wanted was, look, you can't invest if investing is going to put you on welfare. But here's the problem. There's no restriction on you putting all of your money in candy bars and then leaving those candy bars on the street.
Right.
It doesn't really make sense. And the real problem wasn't actually people putting their money in things. It was putting their money and then borrowing money. It was the leverage that was the problem. So what they should have done is said, unless you have, like, they should have raised the margin level, right? You can't put 10% on margin. You have to put like 60% on margin, right? You have to put more money down.
Yeah.
That would have actually kind of cleared out a lot of the lower end people who couldn't afford the risk. But they didn't do that. They just said no. And what did it do? It really created this gap between people who were able to access wealth and people who weren't. Because the knowledge gap has always remained. The knowledge gap is people who understand how to build wealth and people who don't, because we don't teach it in school. So you have to learn it from the people around you. It's always taught by the people who teach you how to brush your teeth. And wealth mindset is incredibly different from people who are wealthy and the middle and lower class, right? They think about money fundamentally differently, like so very differently. The difference between cash flow thinking and income thinking it's incredibly different. And this idea of how we think about money and how we use leverage and stuff like that. The problem is, if somebody who doesn't have the understanding of finance, but they will borrow some money, use a leverage account, and then go invest in this company, but they don't really understand how leverage works, what you need to have, what happens if it fails.
Right.
This is where the trouble is. It's not accurate.
Well, who benefits from that leverage?
Mostly it's the lending companies.
Exactly. So to me, the rule should be, because the non-accredited, and I'd love your hit on this, can buy lottery tickets.
Exactly.
$108 billion a year in lottery tickets every year for the last 20 years. They can walk into any casino in America and bet on red, blackjack table, pie gow, slot machine, and lose their last penny. They can walk in, they can use their ATM machine at 3:00 in the morning to buy drugs, no restrictions. So as a consumer, the non-accredited is allowed to go do whatever they want. But the moment I want to make an investment and put my last $5,000 on NVIDIA, or I want to invest it in Grant Cardone's company, I can't do it.
Yeah, that is, it's ridiculous. So there's a test now that you can take. That's a series 82 that you can take. It's one of the only, so there's 3 tests you can take, but 2 of them you have to be sponsored by a broker dealer in order to take them. But you can take a series 82. It's very difficult, though, for people who are not skilled in finance to take this test and get qualified as an accredited investor. So my thought was kind of, screw the SEC. I'll create a class.
Yeah.
And populate the world.
Wow.
With accredited investors. And but I was looking for a grant for that, and so I'll see if I can find one.
Well, wait a minute. Let's just talk about this, because I could scale this to my audience.
Oh yeah.
Can you teach the class?
Oh sure. And here's the thing: is
I can bring the people.
Oh seriously? Because
what does a Series 82 cost?
I don't actually know what the current cost is. It's like around, I think it's somewhere around 1,000, I think, something like that. I think that's what it is for the cost of the test. But you become a broker dealer afterwards. Isn't that funny?
Oh wow.
Isn't that funny? It gives you
just an accredited. You go from non-accredited to broker
dealer. But you're not with a broker dealer, but like you become one, and that's the level of knowledge you have afterwards. But it's not easy for someone to take on their own. So I was like, I'll run a class.
Yeah.
And I'll teach people this stuff. I'm good at teaching, right? So I was like, I'll teach people this stuff.
How long does it take?
Qualified.
How long would that take?
I could probably do it in maybe 3 to 4 months.
Oh my God, that's long.
I know. I mean, it's not.
That's the problem. They just keep adding so many restrictions. To me, it's like does that SEC? Why are you guys keeping people from wealth?
Yeah, but 3 to 4 months is. I mean, considering people have jobs and stuff, you think it's going to be like that's pretty short. I think considering people are working and they have to listen to a class at the end of the day. Like it's not every day. I wouldn't do it every day. You think people are going to listen to it every day?
Yeah, 100%. People want to get through it. They'd rather get through it fast. All
Oh,
right.
well, when I do it, it'd be less than a month. But
Now, can I get it done in 5 days?
could they get it done in 5 days?
Could I get it done over a weekend? Two 8-hour days?
Let me think about it.
Audience, okay. Would you rather take 4 or 5 months? Would there be any interest? One, two. Would you rather 4 or 5 months?
You think they'd actually do it every single day, even after? Okay, even after
If
like
I could get it done in six, if they could get it done in 16 hours over the weekend, they'd rather do that than take 3 or 4 months.
Okay,
The reason I would want
I could probably make that work.
the reason I'd want to become an accredited investor and make sure my audience is accredited so they could get into these funds early, these private funds that offer all the upside. And this is how the rich get rich. Guys, Alex is telling you guys and I'm going to look up the data where it's from, but she's like, the private investment world is the most assured way to guarantee or or leverage your way to wealth. It's not the publicly traded companies that have already.
It takes 40 years to do that. I mean, that's it takes 7 years to do in the private world what it takes 40 years to do in the public world.
See, I thought, because I'm very skeptical. I think I'm more skeptical than you are. Okay, I trust people.
Because I'm like usually like I don't believe anything. But yeah, go ahead.
I trust people, all people, to disappoint me. So
a good way to live.
I thought the reason the SEC was put there was for banks to control the fee-driven world they live in.
No.
So I'm forced to go through them in order to go public, and then they get a piece of they get 2 or 3 or 4 or 5 or 6%, and they're the gatekeepers.
No, and the SEC doesn't keep any of that money. So
I know the SEC doesn't, but Goldman Sachs and J.P. Morgan did.
No, and it never had any connection with the banks or anything like that because the banks are also regulated through the SEC as well as.
Well, they have all the money. It doesn't matter to them. They have time and money.
That's true. But no, it doesn't. It's not set up through the banks. The banks are the banks and the SEC. The banks are not as concerned with the SEC as they are with like the OCC and other regulatory agencies. They're much more worried about like the Fed and the Treasury organizations than they are about the SEC. The SEC is really only like the biggest thing that the SEC regulates are the shares that they're issuing more than anything else. So when they're doing a public offering, that's what they're concerned with. But everything else, they're really more concerned with Treasury. So the SEC is kind of only minorly on their radar.
Okay. All right. So you and I are in agreement about the SEC being a discriminatory organization designed.
Well, I'm not going to say that it's discriminatory in that it's malicious or whatever. I think that it had
whether they are or they're not,
that went awry.
They've created a lot of wealth disparity because of the decisions. Yeah. Now that it's a 105-year-old organization or 95-year-old organization. Yeah. How do we change that? Other than getting people to get at their Series 82, which I'm telling you, I think we can figure out how to do this.
I think we could too. That's exciting actually to think about like, okay, well, what if I got them to just do it for a weekend? I really didn't think about that. That's a good idea. I really didn't
they got to pass the test, right?
What?
They got to pass the test.
They got to pass the test, but I mean,
you would put them in a position to pass the test.
Yeah, that's the whole goal is to get them to be able to do that. Yeah.
Now, recently, the SEC quietly under the Trump administration morphed into $200,000 is now considered a substantial investment that automatically allows my organization to no longer ask, are you accredited or non-accredited? Are you aware of that?
You mean the 506 rules?
Yeah. So we raised money. We raised money for our real estate transactions. And if somebody writes a check for 200 grand now, I no
Oh,
longer
yeah, yeah. Oh, if it's a sufficient amount, yeah.
that's considered substantial and supposedly makes them accredited.
So yeah, the which is weird, honestly.
It's bizarre, dude.
Uh,
It, why is
I
the number 180? Why isn't it 85,000?
it's also like, I mean, how do you know that's not all their money? You know what I mean? Like that could be,
But shouldn't I be allowed to invest all my money?
but how is that? I mean, how does that solve the fundamental problem of if you invest all your money and you lose it now? Like that was the
But
whole
but
issue that
but
started
isn't that
that.
my right? Isn't that my right to lose all my money?
I'm not saying it's your right or not your right. What I'm saying is, isn't that exactly what the accredited investor rule was supposed to like prevent? How are they saying that, it's not supposed to be about an amount that you invest. It's supposed to be about the resources that you have available to you, not the amount that you invest.
Right.
So the amount is like the antithesis of what the accredited investor rule is supposed to be about. So it's like the people who wrote that really didn't understand what the accredited investor rule was supposed to be about. Or are they trying to undermine, like, if you're going to do that, just get rid of the accredited investor rule.
Yeah,
right?
no, I'm with you. I'm with you 100%. Like,
Which is, again, yeah, go ahead, get rid of it, but don't have both, right? Because that doesn't make any sense. So, I mean, I don't really understand. I don't really understand.
we should go lobby for this. We should go lobby for this.
I'm all for
As
it.
long as I'm not leveraging money, as long as I'm not borrowing it, as long as I'm not using a credit card to invest in something. I have nephews and nieces that have known me for 35 years. They cannot invest in my funds. How does that make any sense?
It doesn't, although there's an exception for them. I mean, they could. That's a different thing because they know you and have access to you. There's a
A workaround?
yeah. There's a work.
Okay. All right, let's shift gears now. Let's shift gears. I want to talk about this deep.
That's like the friends and family thing that they can. There's a workaround there.
Yeah, but it's limited. Like when I go mass audience, I think I need to be under a certain number to allow that to happen.
You do, but the issue, there's a sophisticated investor thing also, and then there's ones who have access to you personally, and that you can actually work around because the whole idea is, if it's someone who isn't sophisticated but essentially is able to ask you the kinds of questions that even if they didn't have all the money, but they're able to access your books.
Yeah.
Then it's the same kind of thing. Like that's the whole thing is that even if they don't have the money, but they have the access, it's kind of the same thing. So.
Okay, let's shift gears.
This is legal advice, by the way. This is not legal financial tax or investment advice. FYI, you can't do that on this.
Yeah, but it's definitely
it's just for information purposes only.
It's provoking your intelligence and the question asking, which is what we want to do. I'm dedicating the next 2 years to just this topic: wealth, finance, economy.
I love it.
I'm going to have you because I want to educate America. Actually, what I want to do is I want to unbrainwash America about money.
That I'm all for it. They don't even teach home ec anymore, which is just budgeting.
Yeah.
It's just budgeting. That's not even finance. That's like just budgeting. They don't teach anything anymore. There's no money.
You went from giving legal advice, okay, to consulting. Why, and how are they different?
Consulting's just broader. It's because I do a lot more in terms of understanding business models and things like that. It also allows me to do a little bit more flexible deals with people in terms of what I offer and what I allow, like how I negotiate with people and what I can offer them. So I do a lot more than just help them. And I work with their lawyers and stuff too. But mostly what I do is I help a lot with not just business modeling, revenue modeling, and things like that, but I also help them with risk analysis and things like that. And those are just broader than what law is. Law is like a piece of a puzzle. It's mostly just making sure that all the things that that we do are done compliantly. So that's like the layer on top of it. But I don't want people to say or to come in and just say, can I do this legally? Because that's usually the wrong question. It's, what are you trying to get done? Because generally speaking, whatever people want to do, as long as it's, a legal end that they're looking for, they're not trying to screw people over or whatever, we can figure out how to do it. It just may not look like what they thought it would look like, or it may not be in the time frame that they were looking for, but we can get it done. They just may have an idea of what they were supposed to do, but there's usually a newer or there's like a different way to get it done. They may have just an idea of like, well, it has to look like this because all these other people did it this way. But often that's not the best way to do it. There's a better way to do it, or a way that provides more revenue streams or something like that. So I usually am like, well, let me think up a way to do it that accomplishes exactly what you want to do, and we'll make sure that it's compliant. That's what I offer. And that's that sort of mix of strategic thinking and legal compliance is consulting.
Yeah. It sounds like it's less reactive than the legal would be too. Like,
Yeah.
you're more proactive,
Yeah.
and it would probably make you more money. It's probably more money in consulting than legal.
It is, and it's more fun, and it's more it's a bit more in equity than it is in just fees and hourly basis and stuff like that. I don't like hourly work that much. I like it, I like to be more a part of the team than I am
Right.
just to like, here's your draft of whatever. I mean, a lot of legal work is just going to fall to AI, and it should. But this kind of stuff, this sort of, problem solving and figuring out exactly where the best solution is, that kind of stuff is where I think the real meat is. And that's what I do.
How much illegal you think is going to fall away in the next 5 years to AI?
Oh, a good chunk of it, probably like 60 to 80% of it at least.
Yeah, that's what I would have guessed.
Mm-hmm.
I first heard you in a Spaces on X, and it was a Bitcoin room. I think it was a Bitcoin room.
Could have been. I don't know. I mean, there's a lot.
Bunch of Bitcoin maximalists, and this, and look, I'm just entering this world, so I don't understand it like some of those people there do. And my audience is probably in the same place. What is decentralized finance? What is that decentralized finance? What does that mean?
Okay, so decentralized finance, or DeFi, is technically it is making money without banks, right? So finance is making money, and it uses banks. Decentralized just means doing the same thing without banks. Now, that is not what current DeFi is, but it is the future of DeFi. And it's primarily awesome because it's based on an asset culture as opposed to a debt culture. So finance right now is primarily based on debt, traveling debt. But DeFi is primarily based on assets, traveling assets, right? Assets being repackaged, like moved along, sold, and stuff like that. That's what DeFi is going to be based on in the future.
And so when we hear somebody say decentralized finance, they're using it under the terms of, is that always going to be a crypto conversation or not?
No, it's moving right now into something that's called real world assets. You might see RWA, which is real world assets, which is essentially, or tokenization. And that's basically attaching tokens to real world assets, and then making them a part of this decentralized finance. Now, the reason that tokens or coins, depending on what it is, are attached, and it's moving through what you think of as crypto right now, is because this is the way to do it without banks. Banks right now are focused on fiat. cash
Mhm.
money.
Mhm.
Crypto is right now an alternative form that is not focused on cash money. And the reason that we do it this way is for one main reason is that we can, with tokens, take apart assets and sell them in pieces. And
Mhm.
that's one benefit. The other thing is,
Can you show me a token?
no, they're all digital. It's like what you have
Yeah.
in the ATM before it's withdrawn.
Okay, so how do I see a token? Like, how do I imagine a token?
Okay,
'Cause
imagine
I keep having this like, Grant, you need to do tokens. Grant, there needs to be a token. I'm like, okay, but what does that mean?
a token is just a digital record.
Okay.
So that's really what you have to think of them as. So they can be identical digital records or they can be completely different digital records, right? So this a token represents something. It can be a set of monetary value, or it can be a record like a record of ownership, or it can be a listing of previous owners of things. It can be a patent. It could be anything, right?
Yeah.
So token is
It
basically
could
just
have value or it could have no value, right?
what?
It could have value or it could have no value.
Just like anything in the real world, like a desk. A desk could be super valuable or it could have no value, or
Right,
it could
right.
have value to you,
Yeah.
right? And have no value to anyone else.
Right,
So
right.
just like anything in the world, it could have value, it could have no value.
And I would use the token because
Tokens can be broken up into many pieces and they're always tracked. So one of the things about tokens is that they live on a blockchain. So think of a blockchain as a toll road, and the tokens are payments to travel on the road, right? So we're going to think about first the just general tokens. So when you think of think of a platform like
the tokens are the vehicles, not the toll they're taking.
no, the tokens are the coins that you pay to drive on the road.
Oh, okay.
The coins you pay to drive on the road. So let's think about Ethereum.
Okay.
Ethereum is a road. And to drive on Ethereum, you need ETH, the token. You have to pay ETH to drive on Ethereum, the platform. If you want to do anything on Ethereum, you have to drive on ETH. Now, all blockchain, all blockchain platforms, right, are just roads that go from one place to another. Sometimes they're super cool roads that go from like New York to Miami. Now, it could have nothing on it, and it's a cool road because everybody wants to go from New York to Miami. So the tokens, right, are really expensive because everybody wants to go from New York to Miami. That's Bitcoin, right? Bitcoin is like the New York to Miami road. Whether it has a bunch of stuff on it or not, everybody wants those tokens because everybody wants to go from Bitcoin, from New York to Miami, right? Or Miami to New York. They're all buying those Bitcoins. They want to go from New York to Miami. It basically just transfers value easily. It just transfers value from one wallet to another. It doesn't do much else, but that is a very useful function. Now, Ethereum, right? Originally, all it did was go from like Peoria to Omaha. Now, not a ton of people wanted to go from Peoria to Omaha. So the tokens weren't worth a lot. But what did it do? It built a casino, it built a movie theater, it built a really cool resort, a bunch of pools and spas, and then suddenly all these people were like, "Oh, this is a cool road. I want to go on this road." And so the price of the tolls on Ethereum started going up because more people wanted to be on that road. They're like, all the cool stuff is on this road. Who knew I wanted to be in Peoria or Omaha or anything like? I just want to be on this road. So
Right.
the price of
And the only way to buy that access to the casino.
is to buy those ETH,
Yeah.
right? So
So
then
people then just for my audience to understand, They would then take some fiat out of their Bank of America account and buy Ethereum
By
or
the tokens, right?
the tokens, or buy Bitcoin, a token,
Uh-huh.
Bitcoin, right?
Right. That's another token. That's right.
And they would store those where?
And they would store them in their digital wallets.
Uh-huh.
A digital wallet, so like a crypto wallet, a Web3 wallet, a wallet is just a calculator with a code on it, right? When you open the calculator, when you open your wallet, what it does is it sees all of it immediately looks for anything on the blockchain that has a code attached to your wallet. So everything that you own, any coin you buy, immediately gets a code attached to your wallet. So it immediately looks up and it scans every blockchain it's attached to for your code, and it calculates the total value of all of those codes. And it looks like on your account, instead of just looking like a bunch of words, it just immediately translates it and says, this is how much Bitcoin you have. This is how much Sol you have. This is how much of all of those coins you have. But all it's doing is scanning. It doesn't hold anything, right? It just says, here's all of the amounts that you have. And the only thing it does hold is something called your private key, which is your ability to move stuff out of your wallet. Wallets have two keys: a public key to move stuff into your wallet and a private key to move stuff out of your wallet. So the only thing that your wallet holds is your private key. It doesn't hold any assets. It just holds your private key and that code that says, everything with this code, I'm going to calculate every time you open it. That's all it does.
Okay, and then how's the blockchain different than where it actually sits, whether it's Coinbase reporting it or Kraken or
it's always on the blockchain. All assets sit on the blockchain until you convert them to fiat. They always sit on the blockchain.
So tell me, on this trip from Miami to New York, what does Coinbase look like on that trip? Or
so
Kraken,
Coinbase is just
or
a
the ETF
wallet
where it could be stored.
Okay, it's not stored anywhere. It's always on the blockchain. The only difference between a Coinbase wallet and your own personal wallet, like MetaMask or something like that, where you hold the keys, is that Coinbase holds the private key themselves instead of you. So Coinbase is like an airport locker where they have the master key. So you have a key, but they do too. So if you lose your key, they can come in and get it too. That's the same thing. That's all.
Got it. Okay, that's good. You're doing a great job, by the way. That's why we got to go teach this course, this Series 2 course, because you're going to teach people this course very quickly, and they're going to want to do this with you. Okay, so can somebody just create a new token?
Yes. Anybody can create a token, which is great and terrible at the same time. So it's great because now anybody is free to tokenize anything, which is liberating. It used to take like dozens of software developers a long time to create a token because there's programming in it. It's terrible because people create crap, right? They tokenize their dog. They tokenize their, their plant. They tokenize whatever. They tokenize things that have no value. But they tell people they have value and people don't know better. That is why it's bad. So, but yes, anybody can tokenize anything.
So Trump does a Trump coin.
Yeah. Did he do it or was it someone else?
Well, I mean,
I don't know that it was Trump's Trump coin. Trump does the World Liberty Financial.
No, that's the boys. The boys did the world, but right after he got elected, or 2 nights before the inauguration, he dropped the Trump coin.
Oh, he did that one? Okay.
Oh, 100%.
Oh, okay.
Yeah. So now some people were up in arms because it just skyrocketed. It started at 7 cents. I think it went to $70 or something. And they were like, Grant, what do you think about this? I'm like, people have been buying Donald Trump products for years. If they bought coffee cups, T-shirts, hats, MAGA hats. I'm like, people just want to support Donald Trump. I don't see the problem with it. Now, for the degenerate that bought 1,000 of these meme coins at $65 because he thought it was going to go to 600, and he gets caught, and it goes down to back to $7. Who's to blame for that indiscretion or poor decision making?
Those are two
Trump.
things,
Yeah.
right? So first, we now have this thing that says that meme coins are not securities, right? So we don't have a blame aspect, right? We don't have a you didn't disclose aspect, because previously there was really no doubt that these meme coins looked and quacked a lot like, securities ducks. They were very securities like. And so this idea that how are these things, these celebrity meme coins, not securities, it seemed awfully not good, right? But now we have this thing saying, meme coins are meme coins, and it is what it is. So there's not really a blame aspect here. For the people who are betting on meme coins, that's like all the people who are buying, like snap bracelets or whatever it is, and trying to resell them. Look, you're getting a fad. You have no idea how long that thing's going to run or when it's, going to crash or whatever. There's nothing behind it, right? That's the whole thing. There's no there. So who is to blame? Like I don't know that there's not a legal blame aspect. Is there an ethical blame aspect? You got to know what you're getting into. That's the whole thing is, look, I'm happy getting rid of the accredited investor rule, but I'm not here to parent people. So
Right.
the rule is still, look, if you want to get rid of this thing, you still have to take responsibility for your decisions. You have to learn about what you're investing in. So I want people to get involved in the in securities and investing and things like that. But it's still incumbent on each investor to understand the risks involved in investing. So, at the same time, I'm going to say we're all still responsible for our decisions.
Right.
I want there to be like, some sort of, there should be some, minimal disclosure saying, this is a meme coin or something like that. So people understand this is a meme.
Well, it said it on the coin. This coin has no value.
Then what are you going to do?
Exactly. Now, let me ask you this. Do you think, based on your experience, okay, since the young age of 16, is there any other way to create wealth other than investing?
I mean, there are lots of ways to create wealth, but what I'm talking about is what is the most assured, reliable way. There are many ways to create wealth. And a lot of them are luck-based, right? The best way to create wealth is to have the right parents. That is the best way, right? Most people that are wealthy had wealthy parents. But I don't really know how you pick the right parents. I mean, when we figure that one out, I'm going to redo a few things. But barring that, the only reliable way, I actually had a whole course on generational wealth. I don't know why, people don't really teach that. There is a set way of how you build generational wealth, depending on how old you are when you start and how much you have when you start. And I started from less than zero. So, if you don't build it in your lifetime, your kids certainly can, right? Every single person has built wealth in this manner. No matter, like, if not, if your parents built wealth already, or if your family's wealthy, it's in the ancestors. They built it this way. Every single one has to build it in this way, right? You go through a period where you're basically collecting, some seed wealth, and then you move to whatever the accredited investor status thing is in your country, and then you have to invest in an array of companies. So even if you're an operator and you sell, that's insufficient to generate accredited investor status. You always shift to investor, because generational wealth means supporting yourself plus one heir with the interest of the wealth that you have. And right now, that's mid 8 figures. So you have to
mid 8 figures. So how many? What number is that?
Oh God, the last time I calculated what?
50 million?
It's a little higher. I think it's like 65, I think.
So 65 million gets you what?
It's U plus one air on the interest. Will support U plus one air on the interest. It depends on the inflation rate at the time, but it's U plus, it'll support like U plus one air for life, basically. That's
Uh-huh.
generational wealth.
Oh, interesting.
So
I haven't heard that. I haven't heard that term.
what, generational wealth?
No, no, I have heard that term.
Like,
I didn't know there was a number attached to it, but I love that.
yeah, yeah. And it changes, right? It changes because it has to be essentially, you have to look at the lifespan. It's like an actuarial thing, right? But you has to look at the lifespan, like living a reasonable life, but assuming that you're not living in, a low cost of living area, right? And it has to be, like a reasonable lifestyle. And the problem is people think that that number is much, much lower than it is because the interest payments aren't actually as high as people think it is. And U plus one air for life, assuming that you're like, say, 30 years old with a newborn, that's a long time.
Yeah.
Money runs out quickly.
Yes.
So that's you really have to actively continue to reinvest. That's the other thing, is that then you have to mix in bonds plus new investments, and you have to actively reinvest. So people who are wealthy are still active investors. When they're not, they're the Vanderbilts, right? Like you have to actively be aware of finance. Like that's their job, is to preserve wealth. So anyway, money is important to everybody.
Yeah. Very, very important. Okay. I think there's 5 ways to create wealth. Okay. You gave one of them, parents, inheriting. So you got to go get it. We got to do a class on how to inherit from the right parents. Marriage.
How did were you born to the right parents?
Oh, no, 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 no. Well, I mean, I was to some degree. They worked hard. I mean, that's what my parents taught me. And because they worked hard, I worked hard. But my kids were born to the right parents.
Yeah, for sure.
Okay. Now, the other way is to marry it. My wife married it. Okay. I highly recommend that. Do you recommend marriage for men or women as a route to creating wealth?
No,
Why
absolutely
not?
no.
Why not?
Um,
You can marry more money in one day than you can make in a lifetime.
I absolutely don't. So I grew up the child of a single mom. So my sister and I are products of a single mom who we had a period of time where we struggled.
Mm.
And I don't know, my mom taught me don't ever rely on someone else for your
Of
wealth.
course. Of course.
Because honestly, it's like there's always strings, right? If something happens, if they abuse you, if something doesn't work out, you're stuck. Or
Yeah.
you're never sure about your livelihood. Like that's the one thing I want my kids to know, is that whatever they want from me is not subject to, like, my love is unconditional. It's not, it's only to one direction, right? It's their love to me is always conditional, like that you treat them well or whatever. Like my love is, there's only one kind of unconditional love in the universe, and that is parent to child, and it's unidirectional. But it is, I never want to feel like I'm trapped, and I don't want anyone to feel like they're trapped. And the truth is that if a marriage has a condition like I married you because of your money, then the reason I'm with you is because of your money. And then my safety, my livelihood is dependent on your money, and I'm trapped here, and I'm not here by choice. And I don't ever want my spouse to feel like they're not here, like I'm not here by choice. So, and I'm not saying that's about your marriage. I just wouldn't recommend it. It's just my marriage is a very different kind.
No, but I'm not. My wife didn't marry me because I'm rich, but she did marry smart. I mean, there's nothing.
She did. I mean,
It
look,
wasn't
I know a
dumb what
lot of
she
people
did.
who did. I know a lot of people who married much richer than I did. It's
If I was a divorcee or a widow, I wouldn't go marry a broke person.
I wouldn't say that. I certainly didn't either. I'm married for values.
Yeah, I understand, but there is always going to be some dependency either way. Like you're not getting rid of the strings. The unconditional love thing, that was a great speech, but the reality is if your kids didn't treat you right, if your kids didn't treat you right and they didn't respect you, you'd probably start pulling some of the strings.
I can't imagine them
Yeah, exactly.
not treating me well
Exactly.
though, but
Exactly.
we just have like a very, I don't know, we just have a very different relationship, but
Yeah, no, I'm with you. I'm with you. And I love my kids and I do anything for them. And I totally get what you're saying. Okay. So then there's work, there's business and investing. There's 5 ways. Marry,
uh-huh.
inherit, work. Very difficult to work and create wealth, but some people do it. Own a business or invest. Which of those 5 ways do you think is the easiest way?
The easiest is to be born to the right parents. 100%.
But you can't control that.
No. Uh, the easiest, I mean, probably marriage is probably the easiest.
The one you
I
don't
think.
promote. The one you don't promote though.
I don't promote that. I mean, work is
very,
hard to
very
get.
difficult.
What? Work is
Very difficult.
especially because everybody is 1/3 underpaid, like they're paid 30% of their of their wage. Whatever you're paid, it's 30% of your weight of what you should be paid
Yeah.
based on, the 1980 numbers. But an operating company, that's a terrible way. I mean, the odds are against you. You've got
Totally.
80% chance of failure. So it's got to be investing, because that's like, yeah.
So what is, and I'm gonna do this. This is a sexist statement because you're a woman. So, but I'm gonna do this anyway. What is the biggest mistake you see women making with regards to investing?
Too conservative.
Too conservative.
Too conservative. They're way too conservative.
Yeah.
They all go with like just plain savings interest accounts or I mean, even in funds, almost every fund I see that's female led, even in like seed funds, they're like follow-on funds. They're like not even, lead funds. And they always are asking, should I do this? Is this okay? Like, it's like they're checking who else is involved. And,
I think there's a tremendous amount of, I don't trust myself, so I can't trust you. I read a statistic said 83% of women have their money sitting in a money market today, presently.
Yep. I believe it. I believe it.
About, the biggest generational transfer, it's almost $75 trillion is going to hit a bunch of women here over the next 15 to 25 years. And I'm really concerned about women. I was raised by a single mom, just like you. She did not know what to do with money. She didn't know. She only knew how to preserve it and clip coupons and try to find the best deal. But she became clueless when it was investing because she didn't trust herself. She then couldn't trust others. What advice would you give women?
Oh man. So here's the gender divide is that men only see upside and women only see downside.
Wow.
And I would really love it if both could like see each other's side, right? Women need to think bigger, so much bigger, and see their own potential. That there's so much upside and possibility that, and it's some of it is genetic, like the fear-based. Like people are fear-based for the most part. We will avoid pain much more than we will seek pleasure.
I agree.
But women tend to do that more than men, right? Women will avoid pain more than men will seek pleasure over avoiding pain, right? And women tend to like analyze consequences more than they will just attack results, right? And men don't analyze consequences enough sometimes. So and I know that I'm making huge sweeping generalizations here, but for most women, I would say stop over analyzing. Just move forward and seek results. If the results aren't what you want, pivot, just change. But you'll see a lot more positive results than you expected. A lot of them, right? The downside is not nearly as prevalent as you think. That is really, I think, that just trying to preserve is a downside. And I think that's probably what I would say is that that women don't see missed opportunity or lost opportunity cost as a downside, and that is something that I think women, I think I would love to see them capture that more, because they don't really see their own potential, and they tend to. I see so many women who see their potential growth as like so moderate, instead of like, I'm going to capture all this market, like I'm
Right,
going to do
right.
all this. And you're just like, you can do all
Yeah.
this stuff. Like, go get it. Go get it.
My that reminds me, my wife had a women's conference. She asked me to go speak, and I said to this audience, I'm like, there was about 800 women there. You should speak at one of her conferences in the future. They will love you.
Oh,
And
awesome.
and I said, you guys want your independence, but what's your target for financial independence? If you truly want the
100%.
and there is no finance, that you guys don't have a financial target. So that brings me to this question for you. What do you think today? And I know it'll be dependent upon age. So let's just assume that the age doesn't matter for a second, even though we know it does. What do you think the number, the financial number for how much a person needs invested, to almost ensure their financial independence?
Oh,
Knowing you can't guarantee it, but what do you think the number is?
um,
Invested.
I mean, so right now I probably say around 250,000 um would probably do it if it's invested well, and it'd have to be the majority in high growth.
And what kind of returns annually would you be seeking on that 250?
Well, so I mean, for that would have to be something where you're seeking high returns. So,
No, north of what? You're talking about north of 15.
something like that.
Yeah.
You'd have to be doing aggressive growth on that.
Yeah.
And that would actually, I mean, that could actually do it for most people. Like you could downshift fairly quickly once you hit, say, once your holdings, like, because remember that you have to capture profits. That's one thing people don't remember, is that you have to aggressively rebalance and capture profits. That means that once you have to like figure out what percentage in your portfolio you want to have, as let's say you have 75% high growth,
Mm-hmm.
and you have something like um you know uh like 10%, maybe something like a moderate growth, and then
The other 15 in a private fund like mine.
yeah, and then you've got so what you want to do is if the high growth, as it grows, you want to like, and then it pushes out the others in percentage, so then it becomes 85,
Right.
90% of your fund. You need to sell and rebalance that so it's always 75%. That's how you make sure that you're constantly building your portfolio, because one of the problems is that people pretend that they're like those rotisserie ovens that are like set it and forget it.
Right.
Money is not like that. Money is not set it and forget it. You've got to constantly like look at your portfolio. If you want to make sure that you've got this money and you're going to maintain it, you've got to continually look at it and say, okay, whoops, this is, I'm overbalanced on this. Or one of your smaller amounts has suddenly grown too large, you've got to rebalance that. Make sure you're moving that into your higher caps. So you've got to just continually make sure that you're capturing profits, rebalancing. But you could actually, and then you can actually pull it down in risk as you grow.
So
So
the 250 number, you're trying to grow to what number to ensure somebody, okay, you're set, you're good, you don't need to depend on a man.
I would say, I mean, I'd want to make that honestly like a couple million.
Okay.
Yeah.
And what's the number for you that you're like, okay, I'm good?
I don't have a number of I'm good. I mean, I'm constantly like, I really don't. I'm
Yeah.
constantly like more. That's
I
not,
like that. I like more. I think more is a great, I like s'mores and I like more.
I can't help it.
Why can't you help it?
Um, I'm an innately competitive person. I don't think I'm mean or anything like that about it. I don't think you have to hurt other people to be competitive. I'm just wildly competitive. And I'm constantly like better. I want better. I want more.
Yeah.
I want better. I want it bigger. I'm
I
just
love
like
that.
that.
I love that. I love that. That's what we call 10X. Never satisfied. Okay, one more question, and I really appreciate your time today. This has been fantastic. Um, have you heard anything about what I'm doing with this real estate Bitcoin hybrid?
No, what are you doing?
So I'm basically taking a piece of real estate that a multifamily, large complexes that cash flow positive. We don't build it. We pay cash for that asset, and then we go out and pay cash for Bitcoin, and we put the two together as a hybrid.
Okay.
So I have a very illiquid asset, the real estate, and a very liquid one, the Bitcoin.
Okay.
And one cash flows, one doesn't. One comes with a big tax write-off because of the tax loopholes around the accelerated depreciation with real estate. One's very volatile, one's very stable. We put them together and we wait for 5 years for rents to grow and for the Bitcoin to do its thing. How do you like that combination?
I think it's great.
Okay.
I think it's great. I think you can actually do more with it. But I like it.
Like what? What more would you do with it?
Well, depending on what you're doing with the real estate, is the real estate it's rented out, right?
It's all rented, $4,500 a month rents on 360 units.
So, are you
So it's like Sailor's treasury company
uh
or what treasury companies people are doing. But in this case, we actually have a real utility being housing where people live. They're paying. There's positive cash flow. The free cash flow also about
I get it.
point.
I get it. There's a lot of other stuff actually you could do with housing stuff, and that. Um, you could actually use the free cash flow. Would you be interested in doing lending at all?
Not in that vehicle because I think the story gets
In another
muted. I
vehicle.
think it gets confused. Oh, in another vehicle.
Would you use it for another vehicle, for cash flow to another vehicle that would return in, say, 2 years?
Possibly, but possibly. I just think it confuses the story.
No, in another vehicle. Like use that for another one. You could get cash flow from another, you could do another vehicle.
Oh,
Does loans for another vehicle that for housing
uh-huh.
that returns in 2 years.
Oh, we got to talk about this. We should talk about this because I can raise the money for that.
Because then that actually.
I thought you were going to go down token land. I thought you were going to go in.
Oh no, you've got a ton of stuff you can do with that. That's actually a very interesting. No, that's actually a very interesting kind of a play. And then the other thing that you can do is there's a huge market right now in big private credit deals, like 100 million credit deals. So the other thing you can do is monetize those private credit deals and use that on like a secondary market. So let's say you have, for example, you monetize. So let's say, like, there's people who want these $100 million credit deals, right? And you have to do that 20 million or whatever in advance. You have to put down money in order to get access to this money. So let's say you help fund, or you're the broker for the 20 million. I don't know if you like what kind of access you have or want to have or whatever it is. And then you tokenize those loans. You could. And then you can resell those, because those loans are for land, right? So you can tokenize those, or developments, like big development. So you could tokenize those and resell them. And this is actually DeFi, right? Because then you can tokenize those and resell them. And those would actually be what I call CAOs, right? Collateralized asset obligations, right? Because
at what point do I become a security, though? At what point is that a security?
It would be a security, but why is that a problem? That's not a problem. How is that a problem? I mean, it's a private market.
I do like the way you're thinking, though. I like your thinking. You've gained a lot of trust in me, because you've one of my favorite words, more.
It's just like there's so much money and deals to be had in this kind of stuff that I'm just like,
let's figure that out.
More.
Let's do more. So
that's why. And you asked me, why did I move from being a lawyer to a consultant? Because it's like, why did you stop there? There's more.
Hey, you've been great today. Thank you so much.
Thank you. I really appreciate it. It's really
been very useful. What you and I are going to talk about how to do more, and we're also going to talk about this Series 82. Okay.
Yeah, for sure. Let's populate the world.
Hey, thank you so much for being on 10X Money Talks. I really appreciate it.
I appreciate you too. Take care.
Thank you.